Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. The next 20 odd minutes, we'll talk about 2 or 3 key aspects of mutual funds. Now, I know we've spoken about debt funds and the impact of rising rates a couple of times already in the last 4 or 5 months. But I think now that we seem to be on the annual of this event probably happening, I use the term very carefully, probably happening. I think it's important to yet again get a flavor of what the landscape is like and what you as an existing or a new investor can do with regards to your debt fund portfolio. In addition to that, I think so many people, last week we did the show of, in the show we also spoke about the index funds and Nifty, index funds and Nifty ETFs. And some of you asked me that if we are owners of large cap funds, is it prudent to stay invested in them or switch to some of these passive products, so to say? So we'll ask our guest about that. More importantly, defense is a sector that is hot and in flavor right now, not just in India, across the world. We have one of the mutual fund houses launching its first defense fund. I'm sure others might, I believe others might follow suit. So it becomes pertinent to understand whether it is a sectoral or a thematic opportunity that a lay investor should lay her or his hands on. So with that preamble, let me welcome in on the show Uday Dhoot. He's partner of Venn Wealth. He joins us right now for the first time on the MF show. Uday, great having you. Thank you for joining in.
Thank you so much, Neeraj, for having me.
And the pleasure is ours. Uday, can we start off the bat straight away with the debt funds, with an assumption of the hypothesis that there'll be some rate tinkering, if not as large as what happens in the West? What should an average debt fund investor do with her or his portfolio, both existing and the newer investments?
All right, so multiple questions there, Neeraj, and let's take them one by one. Before we even address any of these things, let's understand the basic principle of what happens with debt mutual funds. So essentially, debt mutual funds are buying interest accruing bond securities. And one basic principle of any kind of bond investment is that when the interest rates go up, the bond prices go down. And when the bond interest rates go down, the bond prices go up. So basically, interest rate and prices of bonds are sort of inversely related. And because mutual funds, unlike fixed deposits, have to be priced on a daily basis, the NAV gets priced basis how the bond securities are being priced. So very simple fact is, if interest rates go up, bond prices will go down. To that extent, NAVs of debt mutual funds will go down. That's how it essentially works. Now, within the debt category of mutual funds, there are various different types of mutual funds. There are something called the overnight funds. There are these long duration GSEC funds. And why is this overnight and long duration sort of thing important for us to know is that the interest rate risk of a debt mutual fund, which is basically how violently will the NAV of debt mutual fund react to interest rate movement, depends essentially on the duration. The longer the duration of the underlying securities, and we are becoming slightly technical here, but we can't help it a little bit here. So the longer the duration of the debt securities or the debt mutual funds that you hold, the higher will be the impact on the prices when the interest rates go up. The lower the duration, the lower the risk that you hold. So first things first is that if interest rates go up, debt funds are likely to see temporary negative returns. And temporary is an important bit here. This impact may not be seen in overnight funds, in money market funds, because they hold very low duration securities, which mature very quickly. Now, this is a slightly thing here in terms of understanding, and Neeraj, if I may go a little bit into the technicals here, is that bonds, if you are holding like a fixed deposit, if a fixed deposit was listed, its price will keep going up and down as interest rates move. But if you hold the fixed deposit until maturity and the company pays up the principal and the interest, you will still get what you were promised when you entered that investment. The same thing will happen with the debt securities that you hold in your investments. Now, the question is that what is it that investors should do? First is, what should existing investors do? And then we will come to what should new investors who have money that they want to put aside in fixed income securities do. Now, let's talk about existing investors. when you're talking about existing investments, this is already some investment would have been done maybe 6 months back, 1 year back, 3 years back, we don't know. So one, we need to understand, and we are talking here first principles. So any investor who's listening to us today is that you need to think through from your own portfolio and figure out what kind of decision you should be taking, right? So how long have you been holding these investments? What is your investment horizon? What is your tax status as to which tax bracket do you actually belong to? And then what is the underlying debt portfolio that you hold? Now, why are these four things important? Is that every time you switch from one scheme, let's just say expectation is that interest. Sorry, yes, Neeraj.
No, please continue.
So let's say you're expecting interest rates to go up, and to that extent, as we just said, chances are that debt fund returns might turn negative temporarily. What should you be do? Ideally, you would want to get out of that fund and invest in some other fund which will not get reacted or impacted in the same manner and form. But every time you get out of a debt fund, you will have to pay capital gains tax. Now, what is that capital gains tax? If you are holding the debt fund for less than 36 months, you end up paying tax as per your tax bracket. So let's say if you've been earning 5% return or 6% return on a debt fund till today, it is not completed a 36 months window, you get out. You pay up almost one third if you're in the highest tax bracket. So basically 2% goes away straight as tax. So then suddenly, does it still make sense for you to move? Maybe not. Maybe you are okay to live through that volatility for some period of time and stay invested. So what I would say is that map your investment horizon with the type of debt fund that you have. What is your holding period? How long will it be before it becomes long term, or if it is a short term investment, and then take a decision. Typically, if you are holding roll down schemes, target maturity debt funds, floating rate funds, ultra short duration funds, um, and your investment horizon kind of matches with what you hold, and obviously overnight in money market funds, then maybe no need to do any changes. But if you're holding long duration funds and you want to sort of step aside from the volatility for some period of time, maybe if the tax impact is very low, you would want to get out and get back in. But if not, depends. So a lot depends on how you are, where you are. This kind of gives you a sense of what happens for an existing investor.
Yeah, no, and viewers, this is important because I think as important as it is to be parked in the right instrument, also the timing of the exit becomes very critical. If you're very close to the 3-year number, and we are in March, so a lot of people might be, because if you timed it accordingly, then you might be better off waiting for a few days and then trying to think about this decision. The show won't go away anywhere. You can play this back again and try and hear about that. For new investors, Uday, though, and who want to invest, typically right now people are not really thinking 2 years, 3 years out, let's say. And if they are thinking the near term, because there are some immediate goals, there are some immediate liquidity needs that might come about. If we divide the bucket into 3 months and 12 months, what is the nature of the funds that people should invest in? And if you can give us maybe a recommendation or two of some of the funds which might be prudent for or good for somebody to choose.
Sure. Neeraj, before I just step into that answer, I just wanted to add maybe one point that I missed adding, is that the general optimization in debt funds is not very high. If selecting A debt fund versus B debt fund, it's not that the return differential will be like 3-4%, which is why the tax consideration on changing of debt fund becomes that much more critical. So you need to be really aware of your cost, both the cost of the fund as well as the tax before you start making those changes. Now, coming back quickly to the question of new investors saying that, hey, I have 3-month money or I have 1 year money, what should I do? So if you're like a three-month money, if you're like ultra conservative guy, then just maybe stick to money market and overnight funds for some time now. And within those overnight or money market funds, you can have maybe an HDFC, an ICICI, Kotak, or an SBI. All of them have funds in these categories. You can choose anyone. There's really not much to choose between A versus B. If you are okay to take a little bit, saying that no, can I earn like a slightly higher return, then maybe you would want to look at ultra short duration funds, again from IDFC, HDFC, Kotak, SBI. Really not much of a difference between these schemes as such. So if 3 months overnight money market or ultra short is what you should be looking at. If
what's the difference? Sorry, what's the difference between the money market funds and the ultra duration funds in terms of returns?
So in terms of returns, what will happen is that the ultra short duration funds will basically be holding 3 months to 6 months securities. The money market will hold anything less than 3 months. So to that extent, what will happen there, they get priced very quickly. So to that extent, it will carry less interest rate risk. The return differential will be like maybe 20-25 basis points, not more than that. Which is the whole point. In debt, over optimization may not be a great idea because the optimization just yields so much, right? If one is then looking at a 1 year investment horizon, then you could still stick to an ultra short duration fund, which will still yield you maybe a decent return. And as interest rates go up, because they are holding six month securities, they will get higher YTMs maybe 3 months later or 6 months later. So your net outcome 6 months down, 12 months down the line might be decent. That is one. The other possible option would be like doing the Bharat Bond FOF 2023, which is basically maturing right after 1 year. So you kind of know this is going to mature after 1 year. I think that fund is yielding maybe around 4.95% or something at the moment. So that is the other option that you have. Like I said, really not much in terms of optimization available within debt funds. So don't trade too much. Stick to whatever it is, and maybe when you get opportunities in other asset classes, use them.
Okay. Well, that and maybe that last line, viewers, the quicker you agree to that, the better it is. Because I think a lot of people will also tell you, viewers, that if you really want to take risk in equity funds. In debt market funds, stick to goals and stick to tried and tested. Maybe that helps. But
I think safety, liquidity in the debt. In debt, it is safety and liquidity, essentially. Yeah.
Safety and liquidity. Yeah. Well put. Very well put. Thank you there for that. Now let's swap then to equities. And I think last week when we did a show wherein we told people about what is the sum required for 1 crore in 5 years, or for that matter, the difference between Nifty ETF, the index funds and Nifty ETFs. I think some people wrote back that if they have large cap funds, are they better off swapping to the passive products? Because the degree of outperformance, not just over the last 1-2 years, but maybe over a slightly longer time frame, is not that much for an average fund. What would you advise?
So two things here. I think data is clearly favoring index funds in the large cap category. I think that is certain because what has happened over a period of time, SEBI has got very, very categorical in terms of what is large cap. The definition has become very strict. So to that extent, the maneuverable capability that the fund managers earlier had has got limited. And to that extent, the alpha generation capability has got limited. And whereas an actively managed large cap fund will have higher expense ratios, you are now getting index funds at basically free of cost, pretty much, with some of these newer MFs that are coming through, right? So for them to generate these extra return might get tougher. So I think incremental money to large cap from new investors and existing investors should definitely go to index funds or to ETFs. For existing investor, the call might again be dependent on tax implications, right? Because if somebody has been investing over the course of last 2-3 years, you are sitting on fairly decent capital gains, and the cost will be upfront. You selling and moving to a large cap will mean paying taxes upfront. So maybe you want to check at that first before you take a decision to saying that, hey, I want to switch. So I don't know, switching is so critical right away. Maybe you'll get more opportunities to do that, but incremental money should go into index and ETFs.
Very well put again, Uday. Thank you for that. The final question, Uday, on this show, and that is about a sector that is in vogue right now, not just locally but globally. Almost every single money manager that we speak to say that maybe just investment can be great. And of course, India is embarking upon a bit of a self-reliance, not a bit of a self-reliance. The Atmanirbhar theme is pretty much alive and kicking, more so in defense. And therefore, this launch by one of the fund houses, and probably others might follow suit, will be headlines. Now, my question to you is, whether it's HDFC or some other funds which might launch defense thematic funds, is it prudent for investors to straight away jump into them? Or is it prudent to wait for a bit, see the performance, and then go for them? Or is it prudent to not go for a thematic fund, especially something which, at least in the last few years, has had many false starts. We went so many times, but in defense companies have gotten orders and then suddenly it cooled off the next couple of years. So how would you look at this theme and investing in these thematic funds?
Let me make two things very, very clear. And so basically, I'm just calling out my own biases here. Is that one, I feel as an advisor myself, I am not as well equipped as fund managers to pick up sectors and segments within sectors which are going to do well. I think I'm better at working with my clients and building a portfolio, not necessarily picking up sectors. So to that extent, philosophically, I don't buy into the idea of buying into sectoral funds and switching in, switching out. The other issue investing in sectoral funds, and I'll address the question. I just wanted to get this out. So the other piece of investing in sectoral funds is that sectoral funds, barring maybe a few, are funds where you have to enter and exit. They are not just buy and hold forever kind of categories. For them, your equity diversified funds are better. So to that extent, I feel for most investors, you should not do sectoral funds. If you're doing an equity diversified fund, if a sector is likely to do well, any fund manager who's managing the money will invest more money in that sector, right? It is a foregone conclusion he will do that, right? So you don't need to double this up for yourself, because you will then have to figure out, okay, when do I get into this sector? When do I get out of that sector? And we have seen that the biggest of losses or the biggest disappointment for almost all investors happened in sectoral funds. This happened in 99 with the IT sectoral funds. This happened in 2007-8 with the infrastructure funds. So the sectoral funds as a theme remained something which created the biggest disappointment for investors. So I would say don't do sectoral funds in most cases. But if somebody is really keen, and let me then talk about defense. Like I first said, I really don't understand. I'm not a fund manager. I think, yes, on defense now we have noise from both sides. India has been talking about Atmanirbhar Bharat for very long. Globally now, suddenly what has happened between Russia and Ukraine, I think every country now is talking about self-reliance in certain areas, because you can't depend on any country if tomorrow something happens with your country. And to that extent, defense budgets across the globe will go up. This is what has been a conclusion that everyone has been making, and maybe this will play out well. But the point is, we don't know when things suddenly change. For 1 month, people were guessing when will the Russia-Ukraine war start, and people said, "Oh no, nothing will happen. Life will be as usual." And then suddenly all of this happens. I say that stuff like this, for people like most common people and little investors, won't even know what has changed in the global. You are better off holding equity diversified funds. Your fund manager is listening to all the news across the world, figuring out which segments to go in after, and so on and so forth. If after saying all of this, some people are still very, very keen, no, we need to invest some part of our money into thematic funds. I think ICICI has this fund of fund called ICICI Prudential Thematic Fund of Fund, which essentially is a fund of fund which invests in other sectoral funds, and the fund managers are taking a call as to which sector they want to invest in and which sector they want to get out of. I think that is a good fund to invest in if you want a slightly aggressive thematic sectoral kind of an approach. And there are two advantages of something like this: is that one, you get better decision making, because now it is the fund manager who's taking a call of which sector to get in, which sector to go out, and possibly he has more resources than any one of us have to get into a sector or get out of a sector. And second, it becomes more tax efficient. See, every time we trade in and trade out, and this is a big thing that all investors should know, trading in, trading out creates expenses in terms of tax outflow. So if you are invested in a fund like this, they are selling in, selling out, getting into another sector, but no capital gains as such accrue to you unless you get out of that fund. So it is basically more tax efficient, and obviously should have better decision making given the resources that they have at their hand.
Well, fairly important points, both of those in mutual fund investing any which way. So thank you for that as well. And Uday, lovely talking to you. Look forward to talk to you more often. Thank you so much for sharing the time today.
My pleasure, Neeraj. Looking forward. Thank you so much. Bye-bye.
And viewers, thanks for tuning in to this leg of the Mutual Fund Show.